Stewart, your reaction to the news that now another Fed, member and a very important one, Bill Dudley, is retiring in 6 months. What does that do to the FOMC?
Well, clearly you're going to have to add to the board. I mean, we've had vacancies for a while. A lot of influential members leaving. New Fed chairman, Jerome Powell. But I have to say, the Dudley news aside, I think the appointment of Powell is probably a good thing, at least for a change. We're not going to have a PhD economist running the Fed or an academic. I mean, he's somebody that comes from the business side of the world, and hopefully he makes a change. Look, I think individual Fed, board members and researchers and economists, they're great guys, and when I meet them individually, I really like them. But I think the Fed as an institution, needs to change. So I view these openings as an opportunity maybe to move the Fed away from kind of the model-driven institution that it's become, bring some people in from the outside, and become more in tune with the real world. I mean, a good example, Vonnie, is this ongoing debate that's occurring at the Fed now about moving the inflation target from 2% to the 4 to 6% range. And while I know you can build academic justification for that among the economist community, it's a terrible idea for retirees, those at the bottom end of the wage spectrum. And just the fact that all of a sudden they're producing academic research that Ben Bernanke and Janet Yellen seem to be taking this research quite seriously. Well, to me, it's really disturbing.
I think that might be a tiny bit of an overstatement, Stewart. I'm not sure where that thesis of yours is coming from, but let's stick with the 2% for the moment. We can't even get there. So do you imagine that monetary policy will change under Powell so that, the path, for interest rates changes in any way?
Yeah, I suspect not. But even the 2% inflation, look, inflation is just a tax on the wealth of your citizens, right? Even at 2%, whether you can get there or not, the fact that we're not getting there, we're not getting there for the right reasons. We're not getting there because, shell technology has pressed down the price of oil. GMOs have pressed down the price of food. China joining the World Trade Organization, globalization, this, Amazon, Baidu, all of these things press down on inflation. The fact that inflation is still 1.5% to 2%, in fact, his year-over-year headline is 2.2 right now, despite all of this innovation. To me, the Fed should be celebrating the fact that inflation is not over 2 yet on core. And should be welcoming. It's a good thing for your citizens.
Stewart, what's the 10-year telling us then today? 2.32%. It was above 2.4 as the speculation mounted about who was going to be the next Fed chair. What's that figure telling us, and what does that mean for you and your portfolio?
Yeah, so, I think the last May when I was on, I thought rates would fall to someplace sub 2. They got to 201, and now they've risen back. I think last week we got into the 240, 245 zone, and now they're falling again. But I think the lesson for rates, or the thought about rates, is they're in a trading range right now. And really, I'm very surprised rates are still here, given that the term premium is negative. By any measure of valuation, rates are too low. But at the same time, usually low rates are accompanied by a crisis, right? We've had risk assets going straight up for months now, and yet 10-year yields are still here in the 230, 235. If we see a correction in risk, I certainly think yields have a shot at sub 2 again. But all of that aside, it's a large trading range, right? And the math of being long a 10-year Treasury, it doesn't work for the average investor. Future losses so far outweigh potential gains from a flight to quality trade for the average account. So what I've done in my own portfolio, 2 weeks ago, we went from being pretty significantly short very much back to neutral right now. So And again, the portfolio I currently manage it's only a 5-year duration, so it's farther in on the risk spectrum. Our aggregate accounts are a little bit short still, but much closer to neutral than they were 2 weeks ago.
Stuart, have you changed your assessment of what the Fed's going to do, given we have a new chair? Well, if he's confirmed by the Senate, and given there are a number of other positions to fill, I mean, are we on for 3 hikes in 2018, or, as you're suggesting, is more warranted?
Yeah, so I certainly think we get one in December right now because, I mean, we are for the first time in a long time, it's kind of a coordinated global expansion. If you look at PMIs across the developed markets, you know, things are okay. Now, I do happen to think that PMIs are peaking about now and that the economies are going to soften. But I would say, you know, you probably get one in December and probably get one, maybe 2 the first half of next year. Then I think it becomes pretty questionable again, particularly if I'm right and inflation begins to pick up. You know, they could go ahead and do a 3rd one, but, you know, for some reason, higher inflation excites them instead of disgusts them like it should.
Stewart Taylor.
Sorry for that.